Welcome to the Invest with Clarity podcast, where you will learn how success in investing, as in life, is the result of absolute clarity. Mark Pearson of Nepsis in Minneapolis, Minnesota, shares his passion for portfolio management and commitment to transparency and communication to allow investors to fully understand what they own and why, bringing them to clarity in their investments. And now, here are your co-hosts, Matt Halloran and Mark Pearson.
Hello and welcome to another Invest with Clarity podcast with Mark Pearson. And we've got Chuck with us again, which of course is always an absolute pleasure. We are going to dive in to something that is really important, which is the myth of passive investing. And this is part two. Chuck, take it away.
The delusion of passive investing. And we're going to try to seal the deal here and actually set our industry on fire by simply denouncing this active versus passive debate. These indexes that are created, this discussion of what the market is anything but that. If you unravel the onion like we will today, you can see actually that these indexes are created by human beings. The changes are made by human beings, and they actually enjoy the competition with those of us such as Nepsis who report that active management is actually the better of the two. So we're going to make this case, and I know you have deep passion on this. I wanted to just mention one thing too. We're recording this at the end of March, but forthcoming is April Fool's Day. And I kind of thought that would be an interesting way to start off. I think our industry has created many false narratives, and if you look at the Wikipedia Mark definition of April Fools, I want to just lay this out here because I think that they can play the fool. It's an annual custom. We all know this on April 1st, consisting of practical jokes and hoaxes. Jokesters often expose their actions by shouting April Fools at the recipient. The mass media can be involved in these pranks, which may be revealed as such the following day. So here we sit, and I think our industry tries to fool investors quite frequently. And I just thought I'd mention that since we're close to that day. How do you like that?
Love your analogies, Uncle Chuck.
Well, thank you. You got it. So here's the thing, Mark, and you and I have discussed this numerous times. So there is actually no index, and I want everyone to understand this, that defines the stock market. And what I mean by
zero. None? Nada?
There's nada. Think about this.
Then why do we use benchmarks?
Well, I'm going to ask you that question. We only use them as what? A justification for what? I want you to complete that. I love it.
I'm going to only ask one question as it pertains to benchmarks and a correlation.
Okay.
We all know what a report card is, right?
Absolutely.
Has a report card ever decided really how smart someone is, and have the grades always been accurate?
Absolutely not.
So why do we use report cards in the investment business? I'm just asking, just a thought I just had.
And I love your question. I think we've done a little bit of background on this. I really believe that you have a group of individuals who try to classify, they try to jam people into certain boxes, and they want to clean up the messiness. They want order in what is.
I disagree.
Okay, go ahead.
They want to make their jobs as easy as possible and cookie cutter people in the boxes as easy as possible.
Okay.
When you're
managing
lots of clients, you can't take all the time and due diligence to really dig deep into actually what you own and why you own it.
Yeah.
And so therefore, what you do is you have to create processes that include checking boxes. It's not the way to manage one's money and grow one's assets. Checking boxes is not how it's done.
And I love it. I'm going to say this. I agree with you 100%. I think the checking boxes is the creating the order, right? If they don't have a classification, they view that as messy. How then do you know how you're doing? We've talked about this many times. Or how do you know how your investor is doing, right?
Right.
You have to do it on some basis of comparison, they say, right?
Well, a lot of people don't want the details. When they come in to see a financial advisor, many people, here's the fact. My experience has been that most investors, many, I shouldn't say most, many investors are intimidated about their investments. And they're intimidated because they don't know how they really work. They don't have the clarity and understanding how their investments work. And so when you don't understand something, when you are not confident in the process of how you make money, you have a tendency then to say, to really, for lack of a better phrase, dummy it down and make it very generic and simple. And that's checking boxes. And the reality is you can have a combination of checking boxes and making it simple to understand what is really happening with your money. Most people don't know what's happening with their money because they got a hodgepodge of mutual funds and ETFs. They own thousands of stocks, and they're being told by their financial advisor, hey, you're investing in the stock market. No, you're not investing in the stock market. You're investing in businesses. The stock market is nothing more than the greatest place to ever go to buy and sell businesses. So you're not investing in the stock market.
Absolutely.
You're investing in businesses. And people get intimidated by that.
They get hugely intimidated. I just got so excited. And I mean, to cut you off, you're exactly right. And if you take what is the stock market, you just nailed it. It's basically this market of companies where you can buy and sell and transact. So let's break it up. Actually, today, if you take a look at the NYSE, the New York Stock Exchange, right, and you take a look at the NASDAQ, which actually is an exchange, you have roughly 6,000 companies where you can actually make a decision as to where you want to own them. Now, some of those are ADRs, right? That's an international business that trades on a domestic US stock exchange. But here's the thing, Mark, there is not one index that actually takes all 6,000 companies, and that's not including pink sheets or over-the-counter opportunities, right? That you can invest in. So why do we continue to call a group of 30 or 500 or whatever they are the market when it very simply isn't? There's 6,000 opportunities out there at least for folks to buy.
You're investing in businesses. Now, let me take it a step further for you, help you understand one little component of it. We have a lot of business owners that we are clients of ours, and our advisors work with business owners on a regular basis. Business owners look at things very differently. How many times have you ever heard a business owner say, I don't invest in the stock market because it's just a gamble?
Exactly.
I mean, how many?
I hear it all the time.
Right. It's a gamble because they don't know what they're investing in. If they knew what companies they were investing in, like they do in their own business, right?
Yes.
They wouldn't consider it as much of a gamble because they know what they're buying and they know what they own and why they own it. Now, let's take it a step further. Let's say you're a business owner that owns a manufacturing company, or you're a business owner that owns a car dealership, or a chiropractic clinic, or a financial advisory firm, whatever it is. Do you think they have 6,000 options to choose from to go out and buy? No. They're going to have their top 5, top 10 companies. Boy, it'd be great to buy that business. Many of our clients have bought businesses in the past. They're not looking at 6,000 companies to go buy and which of the best should I buy. And by the way, should I buy 50, 70, or 100 of those companies? No, they want to buy 1 or 2. What are they trying to do? They're trying to buy the best of the best.
I love it.
So why don't we want to invest in our portfolio in the best businesses we can? The stock market is nothing more than the greatest place to go find businesses to invest in. And when you make that initial investment, like a business owner, when you invest in a business, do you only do it once? No. You continually invest in your business.
Absolutely.
Particularly when the markets are down, when the economy is down. The economy goes through recessions. You want recessions. You want to store up the house, have the capital available, and when the next recession comes, what do you want to do? You want to go buy stuff on sale. Guess what they call that, Uncle Chuck?
Buy low, sell high.
Volatility.
Yes, I'm sorry, volatility, and that's the evil
thing. Break it down to the basics, right?
You got it. Yes. Well,
sorry, I'm on a tear today.
And it was an excellent tear, which is superb. I want to just pivot for a second, because here's what I tried to do in preparation for this podcast: is I was on search for this idyllic measure of the stock market. What index again, created by human beings, best describes these opportunities, as you said, of 6,000. There isn't one. There's not even one close. So let's take this one called the Wilshire 5,000. Now, you would think just by the title that, hey, maybe 5,000 companies of the 6,000 are in that particular index. And
Wilshire sounds fancy.
It does. It almost sounds regal or royal, like British, right? Doesn't it? The
Etzweiler.
Yeah, gosh. So I was in search of this, and here's what I found. You're just going to love this, and I'm being kind of sarcastic in that instance, is that if you read, so the FT is the Financial Times, which is an index developer like S&P and the Dow Jones. They're a British company anyway. So They put this market cap based index together with the number 5,000. And today, if you look on actually Morningstar and you can buy the index itself, it's got, I'm going to tell you the number, 1,867 holdings. Okay.
So count that high.
You can't even count that high. And here's what I want to show you now. Here it's market cap weighted, Mark. So here are the top holdings, right? In this 6,000, Apple, Microsoft, Amazon, Alphabet, Tesla, NVIDIA, you can go there. It's not that they're good or bad companies. Again, this is, if you were to buy this thinking I own all 6,000, you don't even own close to that. You again are top heavy in these larger companies. And I found that in every single index.
And top heavy is 1%.
Exactly. That's what it is. You got it.
Okay. So this is the conversation I used to have when I used to meet with clients. Obviously, I don't anymore. When I was starting out managing money for clients and also doing the planning for the clients years and years ago, people say, wow, you're putting 5% in one stock. I've had people that have tried to take clients away from us, and they look at the portfolio of the client and they go, wow, you have 6% of your assets in this one company. They would say, boy, isn't that a lot of risk? And my response would be, okay, at that 6% position, do you think that company is going to go away? Well, no, of course I don't. Okay. So if the company's position went from 6% to 3% of your portfolio, that means you've lost 3 percentage points in your portfolio. Is that going to affect your retirement?
No.
Okay. When it's down 3%, if you had the ability to buy more of that great business when it's now 3% and bring it back to a 6% allocation, wouldn't that seem to be, assuming all fundamentals are the same, nothing's changed fundamental, wouldn't that seem to be a common sense thing to do?
Absolutely.
It makes a lot of sense. Can we do that? Of course you can. Now, 3 percentage points on a portfolio is making the assumption that nothing else makes money or loses money in the portfolio at that given time. And I want to harken back to 1999 when people said that Warren Buffett was old, that he had lost it. His investment style was, quote, no longer valid. He had lost his moxie. He was not a good money manager anymore, right?
Exactly.
And then the tech bubble happened. Now, let me take that to modern day. If you took a 3-year chart, a 2-year chart of Warren Buffett's Berkshire Hathaway versus the NASDAQ, or even the big famous tech ETFs I'm not going to mention that they talk about, one in particular. If you go back 2 to 3 years, even with a downturn that big tech ETF has taken, Warren Buffett over the last 2 to 3 years has outperformed it.
Absolutely.
Slow and steady wins the race.
It does.
And asset allocation matters. Okay, I'm off my high horse.
So huge. It's such a great lead in. And I tell you what I did in this exercise, Mark, that you asked me. So we looked at this Wilshire 5,000. I'm just going to rattle off a couple of these others that tout themselves as the markets. 25% of this Wilshire 5,000, the assets are in the top 10 holdings. So which is
how many? I'm sorry, say it again. How many?
25%.
That actually seems high to me in the top 10.
Yeah, and you would think that it is. And I guess it's become more top heavy as some of these companies have grown to be trillion-dollar market caps. And I thought the same thing. But I tell you, I'll say this up front. If you look at our portfolio, over 51% of the assets are in the top. And that's exactly what you said. And Buffett says, would you not want to know a smaller number of businesses and know much more about them and have a conviction, right, than just spreading it all over, right?
Exactly. Yeah. Listen, how many financial advisors that you have met literally call themselves money managers?
They call themselves asset allocators, I think. If they call themselves money managers.
Uncle Matt is quiet today, but he would probably tell you quite a few.
Yes.
Newsflash, most financial advisors are not money managers, they're wealth managers, which means they asset allocate in buckets and they allocate and try to manage the portfolio allocation to the investor's goals and objectives. I'm saying financial advisors are a great benefit. You need to have a financial advisor. Needs a strong word. I would recommend having a financial advisor because they provide great value. The X factor becomes when you're the financial advisor and you know all the details you can possibly know about the strategy of the portfolio, not a fund, because financial advisors have to know everything about 10, 15, 20, 30 funds they put a client in. Our advisors don't have to know anything about any of the positions they have because they work directly for the firm that is the money manager, and they can get access to any information on any company that's owned in the portfolio. And the simple question I would ask any investor is, would you rather have that scenario where the money manager and the financial advisor are working jointly together to help you understand every aspect of everything you own? Or do you want to work with somebody who's going to cookie cutter you and put you in funds that, by the way, have historically great track records, but doesn't mean they'll have a great track record in the future, i.e. this tech ETF that's been getting hammered? Clarity is the foundation of getting every advantage you possibly can to help you, no guarantees, but to help you accomplish your investing and retiring goals. That's why our two mantras, our two questions are not, what were your returns last year and what benchmark do you use? Our questions, are you on track to meet the financial goals you have? And is your portfolio doing the best it can? I'm feisty today, Chuck. My apologies.
You are fighting, but you're spot on, because that's actually what people should be looking at. And that's why this delusion of passive management, I think, is so much on the forefront of our discussion here, because
passive management is easy for the investor to understand. Knowing what you own and why you own it is easy to understand also, but people never get told that. They just get told buy the index because money managers don't outperform indexes. And I've never seen a scenario where a comparison of an index to a client's portfolio is 100% accurate. It's a faulty strategy. It is faulty logic. It doesn't lack common sense. It's not fair to the investor. You are misleading the investor when you use a benchmark and their portfolio is not even managed to that benchmark.
I love what you just said. And when you think about it, how are these benchmarks even developed, or these indexes, right? No one ever asked that question like you just said. We don't even want to think that way. So I want to just read you a couple of things here from an article here, and I just want to get your commentary on this, because I want to lead into the Dow Jones, and I want to just talk about how actively managed these are. So here's what it says. This is an article that was in Yahoo Finance and was discussing basically the composition of these particular indexes or benchmarks. It says, who decides what company gets into the index? With far fewer rules in the S&P 500 and a qualitative approach, how does a company actually get added? In lieu of a checklist type approach, companies are literally at the mercy of a bunch of people who decide whether a company's inclusion makes sense. On the Dow's committee, there are 2 representatives from the Wall Street Journal. Think about that, Mark. So we got people from the press, 3 from S&P Global, and last year they added 1 legendary stock picker to this group. And the legendary stock picker is that guy, David Blitzer, the gentleman that I always talk about that has the bow tie, who since is retired. They replaced another man with him.
Never met him.
Never, I haven't met him either. He's the man behind the curtain. It's like the Wizard of Oz. They determine how much a company should be included in the index, And here's what I want to get your comment on this too. I want you to just think about this. This is the second component. So you got that. So park that thought. And here's the other thought. The Dow Jones Industrial just crossed over about a month and a half ago, the 36,000 level, right? And there was a famous book written in 1999 called Dow 36,000. It took whatever 20 plus years to get there. That's not the point, but here's the point. If the Dow Jones Industrial Average, think about this, Mark, was where it was in 1998 when that book was written, that index would be at 12,500. Now, how does that happen? We've had 28 changes in the Dow since 1998, which has allowed it to get to 36,000. It's an excellent thing, right? The live people deciding what stocks go in and what go, that's active management.
They don't call that is not passive management to my definition.
No. It's nearly 100% turnover. And I'm glad they did it, or it doesn't matter, I guess, what I'm saying. But the point is that this is a ruse that our industry tries to play on everyone. I think you said it great. There is no argument about passive versus active. Everything's active. There is no benchmark, right? That's foolproof. Go ahead, please.
Let's give the media and let's give the industry the benefit of the doubt here.
Okay.
They may feel it is difficult to convey a message that they want to convey to the masses. Let me say that one more time. They may find it difficult to convey a message to the masses, meaning they are trying to attract the masses.
Yes.
Here's the problem with that. Every investor's goals and objectives and risk tolerance are different.
Amen.
You cannot put a square peg in a round hole. And so the easiest way to do this is to make it as generic and as cookie cutter and as checking boxes as you possibly can. Now, some people may like that, and they may think, you know what? I don't care how much money I make. I like it easy. I'll take the easy approach. I don't happen to subscribe to that philosophy. The parable of talents was one guy turned 5 into 5, one guy turned 3 into 3, and one guy turned 1 into nothing.
Exactly.
I want to be the guy who's 5, multiplying the talents, i.e. multiplying the money, which means you got to be different than everybody else. You have to think outside the box. You can't run with the masses. It's like the old Benjamin Franklin quote. What is it? Is it Benjamin or was it Einstein?
It was Albert Einstein. You're talking about doing the same
definition of sanity.
Yeah.
And then what's the one with the pigeons or the ducks out to the water and being left with the water retrieving and they're all looking kind of dumb? Which one was that one?
That was the Benjamin Franklin one. I think
that was the Benjamin Franklin one. Yeah. Okay. I don't want to be in that boat. So
exactly.
That's what we're living in a world that we're living in. And I'll tell you what, I can't tell you how many times today people were talking about an inverted yield curve. What happened 2 months ago with a pent-up demand problem and the supply chain being bottled up? That doesn't sound like a recession to me.
It is incredible. That was another
sense.
Like you just said, the box was checked. And if I was doing
stop the insanity. That's what has to happen.
And it's no wonder. I think there's this confusion, this whirlwind of confusion where people just maybe just raise their hands and say, I give up. Well, at Nepsis, we have such a different message that harkens back to the days, right? We didn't have all this media madness. We didn't have benchmarks. We didn't have indexes. You simply provided a portfolio for somebody based on their needs. You customized it. You bought great companies and you used the price swings, volatility to your advantage. That's the way it used to. That's what Benjamin Graham used to do. It taught Warren Buffett, right?
Since the inception of time.
Exactly.
The idea of economics. I have something of value. I will sell to you for a price. You, on the other hand, have the money. You see the value of that, and you're going to pay the price or negotiate the price to buy that. Doing business. It's been around since the inception of time. The problem we have is we have great technology that makes a lot of information available to people very quickly. And technology is changing. Make no mistake about it. Technology is changing the landscape of investing. And in 1997, I had the same conversations with investors about not investing in an index and how if you can't beat the S&P 500 index, I don't want to work with you. My response would be, if you're using the S&P 500 as your index, no offense, I don't want to work with you.
Amen.
Enjoy your time. And oh, by the way, 3 years later, of course, they found out why I didn't want to work with them. Indexing is a flawed strategy. I love Jim Cramer. I love Warren Buffett says buy an index fund. He says when you're starting out.
Yes.
It's a flawed strategy because it's not an apples to apples strategy.
You got it.
And we try to make it apples because we try to make it convenient for investors because investors don't want to know what they own and why they own it. Let me challenge investors for a minute. It's your money. You have a responsibility to understand what you're investing in and why you're investing in it. If you don't know what you're investing in and why you're investing in it and your portfolio isn't very good, guess what? That's not your financial advisor's fault. That's your fault.
Absolutely.
And so investors like that because they can pass the blame. We've talked about that many times in the past. And that's a bias that people like to have because if it doesn't go well, it wasn't my fault. That's the wrong philosophy to take because ultimately it's your decision where you put your money and why you put it there. And the more clarity and the more advantages you can give yourself to accomplish the goals you want to have, and oh, by the way, sleep at night, I believe that's called better wealth and a better life.
Mark, you nailed it. I tell you, this was probably one of the most enjoyable podcasts that I've done with you. It wraps up our two-part series. I just want to pass it back to you. I think you gave a great pseudo close there. I think you have a couple more words just for investors, just about how different clarity is, how important it is. We know the behavioral component of investing, we think is really what separates people that meet their goals and don't. So I'm just going to pass it back to you and maybe you can close us out here with that.
Yeah, I'll close. I'll give you an interesting story actually from Saturday. It's a great setup and you didn't even know you had this coming. You didn't even know I was going to say this.
Yeah.
I was at an event, a birthday party for my son, and I was there speaking with another financial advisor who works for another investment firm. And he says to me, your son, who's Matt, tells me that your clients are up year to date. This was last Saturday.
Mm-hmm.
So whatever that March 23rd for the record.
Yeah.
March 25th. Your clients are up for the year. I said, yep, that's correct. We're in the green. He goes, that's amazing. That's unbelievable. I mean, everybody's down this year and you're up. He asked me the question, what's your allocation to energy? Because we're underweight energy. I wish we would have had more energy. And as a side note to that, of course, is energy has been the number one best performing sector in 2022,
right?
In this first quarter. And it's public knowledge that our largest holding is Devon Energy. Now, there's a couple of things I want our listeners to learn from that conversation. He says, I wish we had more energy. Two things. Number one, if your portfolio is doing well, like ours is, or if it's doing poorly, wouldn't you want to know why it's doing poorly? In our case, he thought we were overweight energy. And I said, our allocation energy is about 15%. It's not that high, actually. And he goes, yeah, we're just underweight energy. And 15% weight energy is, good. It's not super high. It's not, a 20% pullback isn't going to kill you. But here's the second point of that story. Isn't it great to know why your portfolio is doing well or why it's not doing well? And that the decisions we made to own these energy stocks were not made in the first quarter of this year. They were made 16 to 20 months ago. This is why you have to be a long-term thinker and not short-term thinker. We constantly tell our advisors, we constantly tell our clients, that the decisions we're making today are not designed to have immediate impact. They are designed to have impact in the next 3, 5 to 10 years. That's why it's long-term thinking. That's why Warren Buffett says the person sitting under the tree in the shade is there because someone planted the seeds 10 years ago.
I love it.
You have to be a long-term thinker.
Thank you for listening to another Invest with Clarity podcast with Chuck and Mark Pearson from Nepsis. If you have not subscribed to the podcast, make sure you click that subscribe now button below. That way, every time they come out with a new show, it will show up directly on your listening device. And if you understand that passive investing is an absolute myth and you want to share this with your friends and family, all you have to do is click that share button. So for Mark and Chuck and everybody at Nepsis, this is Matt Halloran, and we'll see you on the other side of the mic very soon.
The content discussed is for informational purposes only. It is not a solicitation or recommendation for any securities that may be mentioned herein. Advisory services offered through Nepsis Inc., an SEC-registered investment advisor.